Perfect. Well, thanks everyone for joining us today, and really great to welcome you also. As some of you all know, I'm Dan Rooke, the COO at co-founder of Start Codon. So we're a venture capital firm based in Cambridge, invest in pre-seed, seed, healthcare opportunities in the healthcare life sciences sector. Joined today by Ollie and Adrian at Taylor Wessing, going to help present the session. And this session is part of a wider session, so entrepreneurial series that we run alongside Cancer Research Horizons. I'll pass over to Matt just to do a brief intro in a second, but it's the second of 5. Big cool math is fine. Second of 5 sessions. We'll be hosting some other in-person networking events and so on over the course of the year. So perhaps I can pass over to Matt, and then you, Ollie, just brief intro on TW, and then we'll kick off.
Yeah, so my name's Matt Farron. I work at Cancer Research Horizons, and Cancer Research Horizons is the tech transfer team / organisation with Cancer Research UK. So my role is to work with COO UK funded scientists to identify translational opportunities stemming from COO UK funded research. That could be anything from early biomarkers, novel AI algorithms, new startups. I'm working with colleagues at Start Codon. We help kind of like seed startups as well. So if you're COO UK funded and you've got some IP to talk about, thank you.
Thank you very much. Ollie, do you want to give a brief intro to TW?
Yeah, so I'm Ollie, I work at Taylor Wessing. I'm a corporate lawyer, joined by Adrian, colleague in our intellectual property and patents team. Taylor Wessing is a full-service law firm that specialises in working with life sciences and tech businesses, and is sort of geared up towards being able to offer all of the types of advice that those businesses might require as they go through the funding cycle, which is the topic of today's presentation. So yeah, we're there to help with fundraising activities, but also IP commercialization and licensing, collaborations, etc. So yeah, it's great to be here.
Brilliant. And so there'll be a Q&A session at the end. Anyone who's got any questions, feel free. If any questions as we go through, again, do ask. But if we can do it at the end, that'll be fine. For anyone joining online, I will be monitoring the chat at the end, so we'll try and deal with questions in the order that they come in. And so today's topic is how to raise finance, the importance of a good IP strategy, and we'll look at more of a kind of a practical view of what investors really look at when you're trying to raise finance, and that's the kind of genesis of the talk. So I'll kick in. I'll pass over to Ollie shortly, and then I'll take the majority of the session, and we'll talk a bit then with Adrian on IP. So thanks ever so much, Matt. So just topic of contents really. So firstly, we're just going to talk about raising finance. What do we actually mean by raising finance? What does that entail? Fundamentally, what are the basic principles? Then we move on to a summary of the finance environment. So there are different types of finance out there, and that will help contextualize really what we're going to talk about today from an investor perspective, because there's huge amounts of various types of different finance available. Most of it, if you're starting off particularly, will not be relevant to what you do. So you're just starting out your venture, you're looking to kind of commercialize your research, then actually you can get quite lost in a myriad of terms that is out there. So it's just to help contextualize that aspect. Then I'll do a bit about what we as investors look for, the kind of the key bits and pieces when we get approached. Because last year we looked at approximately 700 opportunities, trying to filter those on a daily basis, and go through them and find out which ones would fit with, say, our investment remit, which ones we're interested in. It can be quite a daunting task. So this is really a question of, look, these are the things that most investors, particularly us, but most investors look for. So when you come to think about your idea, talking about your idea, these are the things you should focus on. Then we'll talk about IP strategy and monetization, because that's the bit which investors look for, is ultimately how you're going to make money from your idea longer term, in order to benefit you, to benefit other shareholders, and get, if you're doing a drug, get that to patients, you do technology, get it to the market. And then we'll just wrap up with some final thoughts. So what do I mean really by raising finance? Well, in this context, it's really the process of raising money from external investors to implement a business plan. So raising cash to do what you say you're going to do. And as a result, you tend to find with any form of fundraising arrangement, it's a commercial arrangement. And I make that point because what you are asking for is input in the form of cash, in the form of time, in the form of assistance, and then you will be expected at some point to generate an output. And I say that in a kind of an output for various things. It can be investment, it can be exit, it can be an IPO, but ultimately that's what you are doing. So you're giving a part of your business away, and you are going to be, what you were saying to people is you're going to be able to implement this as an idea, and the output in the end for you as the person who's giving money is going to do this. So I say that because it's sometimes quite hard, quite easy to lose track actually of what it is that you're seeking. But also it's relevant in terms of your attitude, in terms of how you write your materials, in terms of how you pitch the idea, is just understanding that it is a commercial arrangement from day one. Doesn't mean it's not going to be a fun ride in the meantime, but it's about understanding it is commercial in nature. And then it's really about, and we'll talk about this more in terms of context setting, it's really about approaching the right people to fund that idea, because there are lots of people who will fund ideas. You will find that investors invest at different stages, they invest in verticals, they invest in different categories of company. And if you can spend a lot of time approaching investors who are not relevant to your idea, or not, who won't be able to help you, or you might be too early for them. So it's really about just approaching the right people with the right idea and appreciate it's a commercial arrangement. And if you don't, that's wrong, and there's misunderstandings, then what we want to avoid is conflict. We want to avoid someone thinking they're getting something from investment, and equally you think you're getting something and then hitting a crossroads. So I'll pass over to Ollie for the overview of the finance environment, and then we'll go back into kind of what investors are for. Ollie.
Yeah, no, thanks, Dan. So, I mean, financing, as Dan hinted, interpret that broadly and you get something that looks like a slide, I suppose. It's a very all-encompassing term, and we just thought it'd be helpful to take a step back, to frame the discussion, because as we said, we're going to focus on the venture capital aspect of things in this session, and it's difficult to understand why unless we have a bigger context, an idea of what the broader picture is here. So here's our attempt at doing just that. Here you've got along the y-axis sort of what investors are looking for in terms of the output that Dan mentioned, so return, and along the x, what their sort of risk appetite might be. And we've tried to plot who we perceive to be the key players in the market. There are obviously others, the types of people who you might be able to go and ask for finance effectively. So let's start with the left-hand side of the graph, knock off the bits that are going to be less relevant to business at this stage. So debt financing, I think we all fundamentally know what we mean by that. Money that's going to be advanced to you, you're going to have to repay it at some point. It's a fixed return for the investor. They're going to have a repayment of principal and a repayment of interest, generally better suited to established businesses who are looking to raise capital to help bolster their balance sheet with their working capital requirements, and accepting that there's going to be a relatively limited return on that. I say this almost exclusively limited to those types of businesses. There are circumstances in which we see early stage ventures looking to raise some form of debt. It's not generally the type of debt that we're envisaging in this sector of the chart, and we'll come on to that in a little bit more detail afterwards. So what's the alternative to debt? Well, equity. And what does equity involve? Well, fundamentally, an investor's putting money into a company, and in return for that, they're getting a portion of ownership and a variable return that will depend on how the company performs over the life of their holding. Within equity, there's a range of potentials, and again, we're covering some of these on the graph. So private equity, for reasons that we'll come on to, targeting more established businesses, slightly lower return expectations than a venture capital fund, and generally pitching towards the lower end of the risk scale, and in general will pitch it as a sort of mixture of equity and debt in order to sort of allow the business to have the leverage and capital that it needs to grow in accordance with the ambition that's set out at the time of the investment. So not typically what the type of investor that we would expect companies that are starting out at this stage to look for, which then pushes you more towards the purple bubbles on this slide, which are VC, high net worth, friends and family. So VCs have a higher risk appetite, return lending between 1 to 10x. As a result, prepared to take significantly higher amounts of risks and much better suited to early stage startups, where effectively what they're investing in are a great bunch of people who have an idea of some IP that is capable of being commercialized and turning into a product that could be sold one day. Before we get to venture capital, often we'll see a company look at high net worth and friends and family. The advantages of those, generally speaking, smooth processes that don't require a lot of negotiation back and forth and not generally particularly restrictive terms on the investment, but not going to be for everyone. Generally relies on connections, pre-existing connections, which frankly not everybody will have as much access to or have equal access to, and check sizes tend to be a bit smaller with those types of investor. And then just to touch for completeness on the other two bubbles on there, so grants. The obvious advantage to those is that generally you're not going to end up having to repay them, but they do come with a number of downsides, or at least procedural challenges. So a lot of time needs to be invested in the process of the application, and at that point you're investing time in a process that they don't have much certainty over. Often they'll only be available if you have match funding in place. So you end up effectively having to run parallel tracks on that. And they will very often come with quite significant strings attached in terms of how you can spend the money, and constantly having to monitor that you're complying with whatever terms being in place as part of the grant, with the threat that they could potentially become repayable. So it can be quite onerous to have to monitor compliance with. And then crowdfunding, which I think we've sort of just put as a bit of a mismatch of everywhere.
You've just shoved it behind the venture capital part.
It is there. We have to acknowledge that it's there. To be honest, it generates a quite bespoke set of investment terms for a company at an early stage that can make raising financing in the future more complicated and difficult than it needs to be, and not really the type of funding that we would expect IP-rich businesses to be looking for, because it's better suited to the sort of household name product type venture where you're appealing to people who are recognizing a name that they're seeing on supermarket shelves or big sort of push them on their Instagram targeted ads, etc. So not one we'll focus on much for these purposes.
It's probably just worth noting the crowdfunding as well. I mean, a lot of these, if you look at venture capital, you look at private equity, other types of financing that's there. There's another form of input in addition to cash. There's experience of sitting on boards, experience of raising finance themselves. So VCs have raised finance to invest the money that they're invested in you. So we've got, from our perspective, we've got our own investors. So, some of the bits that there are parts of this like VC, private equity, where you will gain from the investor's knowledge, the investor experience. With elements like crowdfunding, they're largely passive, right? It's just a cash element, and you don't get the benefit necessarily of the experience of the person who's invested in your fund that's invested in you, or the people who invest in you, like you might get with high school VCs, private equity. So just something to also kind of take account in terms of where you're raising cash from and the other benefits you can get, which are not solely monetary. Sorry.
Yeah. So how do we unpick that a little bit? And focus in on the choice between all of those people. Well, as mentioned, the focus on this session is around VC. The choice is not entirely determined by the type of business you are so much as where you are in the growth cycle. So there'll be plenty of businesses that we see who will raise venture financing eventually, initially, and then end up selling out to PE house. There will be plenty that go on to get to a stage in their growth where they can raise debt from reinforcement debt from banks, etc. But what we've sort of tried to do here, to the extent you can, is plot what you might say is a typical fundraising stage. And Dan will talk to you more about this, but you'll see that where Start Codon fits in the picture at the sort of pre-seed and seed stage where we've got an idea, we've got some IP, we've got a vision of where we might be able to develop a product, but we just haven't quite got a strategy for how that's going to, or we're in the process of formulating a strategy for how that's going to become a product that can be taken to market and sold. So yes, I mean, as this slide shows, along along the bottom there, as more capital is drilled into the business and we have idea moving on to potential product, moving on to research and development of that product, and then eventually revenue, different sources of financing will become more suitable and become available. Now, if you asked us, tell us when typically a venture-backed business will look to progress, we've sort of tried to have a very broad indicative range of dates along there. The exit one in particular will necessarily move along the whole extent of that scale. It's less common for business to achieve exit sooner or later than that, but it does happen. You do get companies exiting just off the back of series of venture-backed fundraising. You get companies, as I mentioned, effecting an exit by way of private equity buyout, and you get companies who get to a stage where they take a significant growth financing, whether that's through further equity or debt before they exit. But this is sort of what we would see as a typical vanilla path for a company that's starting out as just IP and great founders.
I think it's also worth noting as well on the previous graph, the timelines that we've set out there, they're more focused on the life science. And if you've got a business which is more tech focused, or is say, not a therapeutics business, or it's underpinned by tech, or you're not in healthcare and it's a tech business itself, then actually you'll find that some of the timelines there in terms of when you might get revenue, your growth timelines for fundraising might be short. Realistically, might be shortened for several reasons. Partially due to the technology, it takes longer to develop, technologies in healthcare typically, but also you find that, in terms of when you can expect to achieve revenue and you can expect to sell a product, if you're doing something that's fundamentally software based, then you'll find you'll typically get to market quicker than if you're looking to put a drug in a patient. So just something just to contextualize, as Ollie said at the start, very much an indicative timeline with a slight focus on life sciences and healthcare.
And then drilling down into the first 2 to 7 years. So, effectively the sort of first 30 or 40% of that graph. You just plotted here the sort of balance between the risk appetite of a venture capital investor, how much capital is going to be deployed over time, and what that's going to be used to do. So as you can see along the bottom, you're starting out with just an idea, a very small check size, a huge amount of risk. And really at that stage, you've just got great people, great ideas and great IP, but not necessarily a clear vision on how that's going to turn into a product that will be eventually brought to market. As you go through the capital is effectively then deployed to help founders go away and validate that idea, come up with a product, come up with an accessible route to market, demonstrate that it will be something that can be sold, and eventually you'll reach a point where once that's formulated, a more significant chunk of capital comes in and is dedicated to building the team that you need to execute that, to pinning down the customers who are going to buy the thing, and looking at potential collaborations with those people to the extent that we need. That there might be some further input needed to generate a product that's capable of being brought to market. And once we're through that stage, as you'll see, the risk at this point is now starting to decrease, the capital is continuing to increase, and the ambition is that you'll get that product to a stage where it can start to be sold, generate revenues, and at that point we're reaching the stage where the venture capital funds would start to think that they're starting to see value and return on the investment they put in. So yeah, I mean, just to sum up, I suppose as I said at the beginning, financing extremely broad term, all sorts of places that you can knock on the door to finance. But the key is to have to think carefully about which door is suitable to be opened, and what suits best where, what suits the stage that the company has got to best. And going to investors with an opportunity that suits the risk to reward profile that we were discussing, and being able to go into the room with them and explain why you've approach them, not a different type of investor, setting out the ambitions, the plan, how you're going to execute it, and the overall strategy for doing that. Got a sort of quote from Benjamin Franklin that I'm sure you've all heard before there, but it just felt quite out in these circumstances to include, so I won't repeat it. But so now we're just going to sort of turn to or step away a bit from what the landscape looks like and more into the detail of what investors look for. And I mean, I suppose it's related to the general overview that we've given there, but we're honing in on again 3 of those types of financing, and just sort of to give you a picture of how each of these will have different criteria from the outset that you can consider when deciding to approach. So venture funds, as it notes there are lots of different types of venture funds. Limited partner, general partner funds like Start Codon. To be honest, they are the most flexible in terms of what they can and can't do. They'll go out and raise a fund from a range of different sources of financing, pull that money together, and then deploy the capital into businesses they think are promising. Generally speaking, they'll have a sector focus, and we'll have a within the sort of the previous slide, the first 2-7 years, a target point within that range that they'll look for. So they'll have told their investors, we're going to focus on this sector, and we're going to write checks this size. We're going to write 20 checks of 500k and 5 million and 2 of 5 million, or similar. But really, the world is their oyster in terms of how restrictive or permissive they want to be when it comes to setting up their fund and what the investment guidelines that underpin that fund will be. The SEIS, EIS funds and VCT funds are a little bit more restricted in what they can and can't invest in, because they're effectively taking advantage of some pretty generous entrepreneurial tax breaks that exist in the UK. So SEIS funds in particular are inherently limited in the sense that each company can raise 150k of SEIS, so that is a significant sort of barrier to the initial check size that they can write. But that's the type of thing they need to be thinking about, is limits on how much finance can be raised, making sure that the businesses that they're investing in are performing activities that qualify for the reliefs, et cetera, et cetera. So before you show up at the door of a fund like that, it's important to just make sure that you are within the ballpark of a qualified business for those reliefs. Otherwise, it's going to be a bit of waste of everybody's time, to be honest. So speaking generally, typical criteria for a venture fund: investments of anything between 100k and 15 million, although to be fair, we also see some venture capital funds that have capacity to do more, and to finance growth rounds further down the line as well. Anything from startup, pre-revenue, early stage businesses, as I say, venture funds will, if the idea and the founders are right, will invest in just that and take a chance on that. As I mentioned, they can be quite generalist, or they can be very sector focused, like Start Codon. And they're effectively that, as I said, they're just looking for strong people in the management team and people with the vision to build a strong team of talented individuals around them. And generally speaking, that'll be underpinned by a piece of tech that's backed by strong intellectual property, ideally capable of protection. But Adrian will talk a little bit more about those sorts of issues very shortly, and with the potential for that to turn into a product that can be targeted at a large global addressable market. And as mentioned, the return ambitions are very much at the top end. Generally speaking, venture funds will just put equity in. I should mention debt briefly, because we are seeing increasingly that there's pressure on not having a valuation attributed to the business at the very early stage, and therefore we do quite often see investors coming in via convertible debt instruments or simple agreements for future equity or advanced subscription agreements, or whatever you want to call them. But effectively they are prepayments for shares, so they allow the company to raise capital and add by reference to various trigger events, have equity issued to them further down the line. I suppose the reason for flagging is just that some of them are fundamentally would be classified as debt, but in reality, they are just a means of fronting and forwarding an equity investment when investors are not necessarily comfortable pinning a valuation to a business in the very early days. Touching briefly on PE and debt, so private equity, check size, probably a slightly larger range, but again, no real science here, focusing more on mature businesses where they can take a business that's already at the stage where it has potential to scale rapidly, it has a product, it has revenues being generated, but it just needs an injection of capital to be able to scale rapidly and to grow and build in accordance with the ambitions of management. They do tend to come in via a blend of equity and debt to sort of give some leverage to that arrangement and further allow the company to grow. As we've got on the slide there, we've just got a few descriptions of typical types of transactions you see: so management buyouts, buy-ins, replacement capital, development capital. They're all targeting, compared to venture capital, a relatively smaller return, but still pretty significant, 2, 3, 4, 5x, but in a much shorter period of time than venture funds would be looking to achieve it. The debt funds, again, as we mentioned at the top, we're talking more for an established business here. They'll need a track record of trading history and cash generation to have some comfort that you'll be able to repay the funds. They'll need some assurances that you're going to be able to generate the income that's needed to front any interest payments and ultimately be in a cash position to be able to pay that back. With sort of venture debt funds specifically, we're not talking necessarily the sort of financing that you get from a bank, where you'd be told, well, this is a security package and we're going to rank seniors for everything, we're going to get paid out first in all cases. But as debt, they would rank ahead of shareholders and equity holders. And generally speaking, the terms that you would expect to receive from a debt fund are slightly less restrictive than you might have from a bank, more akin to just giving you the flexibility that the company would need to be able to be able to execute on its business plan. As you noted there at the end, it's hard to predict how long that will remain constant for, but you're looking at sort of a 5 or more % coupon on that type of loan. I think I'll pass back to Dan at this stage.
Perfect. So I think, just to contextualize things before I jump into kind of the investor part, I think what we've got is sort of landscape for what's available. We've talked about the fact that different funds have different criteria, and then, we'll just talk a bit about the overarching message, and then what we'll do is then go into, things that we typically see, or actually typically don't see, which do impact our decision as to whether we move forward opportunity or not. But I think what we're when we contextualize the criteria, so you've got all that set out, you know who you're going to approach. So what do they actually want to see? Well, actually, what investors want to see is they want to see a compelling message, a compelling story that grabs their imagination in terms of opportunity, in terms of technology, but it's still about business, and that's in line with the criteria that Ollie has gone through. And so, I think what we're going to get through this, and what you need to be aiming for really is that your story is clear, concise, it's ambitious, and it's also achievable with the resources at a relevant stage. But the point is, it's all about a story. You've got your investor, you've got your criteria, please pull together a story that then aligns with the investor's criteria. And so, when we're looking at investors and the proposal, then what do you actually put in it? You know what they want, but how should you approach it? What's the best thing that you can do to achieve your chance of success from, as my co-founder lovingly described, vampiric venture capital funds, which I don't think we're all, as he also said, bad vampires, but you've got to catch the attention, because if you think that we get 700 applications a year, most VC funds do, right? And they get a huge number. And so they've got to be able to find very quickly the ideas that capture the imagination. And if you buried all that awesome ideas, all those great thought process in the middle of a very long day, the investor's never going to see it, because they've got so many things to look through. They're just not going to get to the meat of it. So, my suggestion of kind of areas that you should focus on are technology, market, competition, team, your financials and what you're going to return, and your target, how you deliver, preferably in that order. And when you set up your deck, don't start it with technology, problem, solution. Don't start it with competition. Start it with something along the lines of if you open a new treatment to treat certain types of cancer, it should be the opening gambit should be this is a problem. And the next one should be, this is a solution. It should be, we can solve this by X. So really, if you're looking through a high level of a pitch deck as an investor, you will look at the titles and then you'll read the content. So grab them at the start. So I'm going to do is go through to each of these. I'll pass over to Adrian at the end, because as we get later down to financial targets, there is a real important part of the IP side that we really need to think about how you actually monetize the idea that you get into. So I'll pass over to Adrian at that point to say a few words on IP and patent strategy. So technology, first bit, investors are not experts in everything. Even if they're a specific healthcare fund, the person who might be reading it might be a biochemist, and you might be talking about a product which is based on biophysics. So they've got no idea. So the starting point is be able to explain technology to an individual who is not familiar with it. It's really hard to do. It's hard to write short than it is to write long. But be able to distill that information in a way that they can instantly read it and pick up on it. If they can instantly pick up on what you're trying to do, they're going to start to look more into more detail at the more detailed aspects of your proposal. But launch it with that in mind at the start. So explain what is your business. What is it that you are fundamentally doing? Don't wait until they get 3/4 of the way down the first page to tell them what you're doing and what you're wanting to do. State it at the start of your first summary, so they get it, so they understand it, and so that they know it's relevant to their criteria. So we get people approach us from. I got the approach the other day from the edible insects business, which is not really within Start Codon's remit of investment. But the point is that get to that point, capture their attention, make it worthwhile for them to read it, and then go through to talking about what it is you want to achieve. So again, problem, solution. What is it that you are focusing on? What do you want to get to with your business? What is it that you are trying to do with it? Is it to get products into patients? Is it to enable people to get products into patients easier? So make that explicit, make that open and obvious to people that you are your target audience. Again, what is the problem oversold? Is it a cancer treatment that you're looking at? Is it a way that you can measure in tumors, or is it enabling technology? So what is the technology? What is the problem? And then go down to see to the solution. The solution will inevitably be what you are doing. It always is, but it's about linking the two, trying to get there to a point where it's easy for the reader to understand. Because if you can do that in the outset, then they're much more likely to read through the rest of the deck and understand then what it is you're doing, what you're trying to solve, and then be able to then pin the business plan strategy from the back end of that. And as I said at the bottom, what is the technology, product, service, as it fits that solution, where it fits in the marketplace. Which kind of leads us on then to marketing competition. And this is a slide actually which we, as investors, we get a lot of founders who come to us and they're looking at a really innovative technology. But we know there are people who are trying to do the same thing in the market because we've done patent searches. We're aware of it because we see businesses get funded. The amount of times we read plans and people tell us there's no competition, no one's ever done this, and then you do a quick Google search and you find a patent that actually creates a problem, or could be an issue, or you find out that another business has started to look at something very similar. So, we get this quite a lot. And what I would say is just do the research on the market, because the market and the competition is opportunity. And the bit that people seem to miss is that, if you tell me there's no competitor in the market, I'm going to go and try and find someone who's a competitor. The issue is not the competition. If there's competition in the market, the idea is validated. It's got legs behind it. What I want to know is if you are entering a market that has competition, how is your technology the best? How can it scale? Or even if it's not necessarily the best, how as a team can you implement it better than everyone else? Because that really matters. Can you move faster than someone else? Is the technology better? It's really using it to address those fundamentals. And it also shows you're aware of your surroundings, because if you're aware of your surroundings now, it gives a great impression to investors that you're going to keep on top of it, that you're going to be aware of what the competition is doing, that you are going to be able to, all businesses at some point will pivot. They will change their focus, or they will do something different, or an experiment might not work. They'll move the business in a different direction. But that awareness of what's happening in the market is really important. And if it's there at the start, it will give confidence it's going to be there further down the line. And so, in terms of what we would typically want to see is an overview of the market. So what is the market like as a whole for what, the parts that you're involved in? The market size, again, if you are looking at treating a certain type of cancer, then, what is the market like? What is the size of that market? How many people, suffer from that type of cancer? What's the survival rate? Because that's going to impact then how they look at how treatable or not that condition is, and therefore what the opportunity is. Again, what are the leading technologies? Help the investor understand who are the market leaders, who's got the gold standard for that technology in the market. Because again, it will help to frame your suggestion that your technology, your solution, it's like water sound here,
It's normal
is the right one. And and again, related to that, who are the competitors? Because what we want to know is, why your technology is better than those competitors. And often it is. We've got a great science, we've got a great biotech scene in the UK. There, pharma goes to biotech for innovation. So it's, it's don't be ashamed to say if what you think you've got is better than what is out there. It's a question of them being able to implement it, being able to raise the finance, and then implementing, raising the cash and then implementing what you've got. But don't be afraid to say if you think it genuinely is. Is there an unmet need? Fundamentally, if there's not an unmet need, but that need is not serviced well, again, another perfectly good avenue, but state it. And then ultimately, and this will come down to what Adrian's about to talk to, what is the go-to-market strategy? How ultimately, when you look at the market, are you going to enter into it? What's your business plan? What's your IP strategy? And also how you're going to make money. But we'll talk about that in a bit more detail later on. Team. We'll put a kind of stat fact at the top, and that is that investors will, team is huge. And it doesn't have to be you've got a team now. It's the fact that you can give confidence that you'll recruit the right team. But I will tell you now, if you ask any investor, you ask any VC, investors will always back an outstanding team with a, average technology than an average team with outstanding technology, because you can have the best technology in the world. If you cannot implement that, if you can't get it funded, if you can't develop it and ultimately get it into a patient or into a marketplace, actually it's pretty pointless, because your technology will never see the light of day. The investor, as an investor which looks for a return, won't generate that return. And so team, hugely important. It's not about having the right team at day one. It's about having the mindset that you are aware that you need to recruit people. It's about being self-aware of your own limitations and about being able to show how you will overcome those limitations. And it's tremendously important. People, don't give enough time and credit to it, but it is people that make a business, not the other way around. And don't ever lose sight of that. I suppose we come into it, just to explain in a high level what each member of your team will be doing and what's their commitment. We get some people who they've started a business, they've, half the shares are owned by one person, half the shares are owned by the other. You find out one person's just working on a business full time, the other person is involved in a business at all. As an investor, that's a problem, because you've got someone who isn't involved in a business who owns half the shares, and you need comfort that person's going to input. If they're passive and they're completely out to it, then you've got to be able to incentivize the person who drive the business for with only 50% of the shares. That can be a problem. So equity allocation, start time commitments, really essential to really think about that. Be honest with your co-founders and the people who are working with you, to get that right. Just explain who the team is, what their experience is, how it's relevant. Just underpins your I guess your credibility. If you've got to again give credibility to the investors that they believe that you can drive that business forward. I always like a good organogram showing what you look like now, how you intend to grow in the next years. It doesn't have to be right, but some thought process into it. Again, appreciating that the team is super important. It's super important for growth. Is great. It also tells investors how they're going to use, how you're going to spend their money, who you're going to recruit, what you're going to outsource, what you're going to build, and it helps to get an idea as to the type of company that you might build day one. Do they have talent strategy? You don't have to have that, by the way. So, but if you thought about talent, if you know anything about it, great. But even sometimes showing awareness of just the fact that you need a better strategy of talent, is a good thing. But if you've got a talent strategy that shows that it links to and show how you want to scale the business. Again, really important, just things to consider and think about. And then, the last part, no one is perfect. You will always have deficiencies and skill sets. Again, my view is own up to them, find ways you can fix them, show willingness to fill those gaps in your team, whether through outsourcing or whether through hiring. But acknowledge where you lack the expertise and show willingness then to actually bring people in to fill those skill gaps. Tremendously important. A lot of people that we invested in the early days, people that are the founders who have a great idea. What we want to know is that what they're not trying to do is hold everything in, that they're willing to outsource certain aspects, so they know where their strengths are, they know where their weaknesses are. You find some people are really into the technological side, but they're not there in terms of their thinking of it as a business. Again, we know we're working with, then we can help that. Again, you might find people are very technologically, they're not very good people managers. Everyone needs a good people management team. You've got to keep your workforce happy. Again, it comes to that, the team being a central part of the organisation. So again, just acknowledging having some self-awareness of who you are, what you need, how you're going to scale up in the future. Really, really important, something that should really be emphasised in the business plan pitch deck or financials ROI. This goes back to the start, the point I made at the beginning, which is that you're in a commercial arrangement here. So, appreciating this commercial arrangement, appreciating getting money in, then showing how you're going to deploy that capital, showing how you're going to spend it. And more importantly, not just how you're going to spend it, but how spending that money makes a difference for your business. Is it, let's say you're developing, an AI platform, but to help, drug discovery for cancer, for example, just pick one. You're going to have different work packages that you're going to have to develop as part of that. And the first part might be building the foundations. Then part might be looking at how you expand the AI aspect of that business. And it's really about saying, okay, look, I've got this amount of money. How are you going to give us this amount of money? I can achieve this work package, this work package. But actually, for these work packages, I can't. I need more cash. But that's no problem, because by the time we've got to this and this, then thinking about where the business is, what the business is going to be, actually we'll have achieved, quite a bit technologically. We'll have hit some milestones. The business will then be valued more. And actually, I can go and raise that amount of money, because we're expecting that if we hit these milestones with more cash, that the business can grow in a way which means we can raise more cash at a better valuation, and we can then do the next work packages. So it's just about explaining what you're going to do with the cash, how you're going to deploy it, and making that into a business that looks viable in terms of its ideas on paper. And so, I'm not going to go through much of this, but how much do you need, when do you need it, and in what form? Because venture capital, any type of finance, is not about raising as much money as possible and finding how to spend it. It's about raising the right amount of money to do what you need to do at that time. Again, what we spend the money on, produce a budget. Most funds, if you go to them, will have a more detailed budget that you can use, but just plotting out a high level of how you think you might spend the cash. Again, really good. If you can do that in part of your approach to investors, they're going to look at it, they're going to listen to it a lot more. Do you have plans to raise non-dilutive finance? We talked about, grants, the terms for that, Innovate UK, other government financing. It's a legitimate part of a business strategy. Now, there are things you have to bear in mind, as Ollie said, in terms of the terms of those grants, how you can deploy the cash. More complex things about the tax consequences of taking such cash. But the point is that raising non-dilutive finance should be part of your strategy most in the early days. And you can, and there are some, really focused grants that come out quite regularly from, UKRI and other people. So, if it's there, look at it. Look out there, work out whether the grant finance is part of it, move it, put that into the plan. Again, we're going to talk about how you make money in the short, medium, long term in a minute. So I won't talk about that anymore, because it's in many ways it's related to the IP strategy. But broadly, what are you going to do? We've talked about inflection points. That's the piece we miss as investors most often than not. Is actually understanding. Okay, you want to spend the cash. What does that mean for you as a business? And then, ultimately, not as essential, but worth alluding to is, if you're estimating that your development timeline is going to be 7 years, then what is your long-term aim for the business? Investors don't need to know how you're going to sell the business, who you're going to sell the business to, but it is nice to get a nod to the fact that at some point the business will have to be exited in some way, shape, or form, and an exit is typically a sale. But what do you want to do with the business? How do you, from an investor's point of view, you've got a great plan, you've put it in front of them, you're going to spend the money, you're going to raise finance for the next round. What does it look long term? How are you as founders going to make your money? How is the investor going to make its money? And how is that going to then translate into wider business? And then finally, before I pass over to Adrian, really the next bit is more of a practical point of, again, you've set all this out. You set out your team, you set out your tenor, you set out, what they're going to do with the finances. So ultimately, you've done all that. We should tell me how you deliver on that. And this is the more boring bits. It's the bits which you may not be as clear on. You don't have to be as clear on. Investors, who are used to working with early stage companies in particular, but also as you find, as they work with later stage companies, they will be used to helping out here. But again, just some points to focus on in terms of wrapping up proposition, in terms of giving some confidence that you'll deliver. Again, don't have to have all the answers to this early stage, but thinking about it is useful. So, how you run the operation, we'll do it. You're going to set up, we're going to do an IT, we're going to on the day-to-day accounting for the company, the really boring stuff, data security. If you're a data-driven business, how are you going to set it up? You're going to build a data platform on Dropbox, then so that's ring some alarm bells. So, just how you do operations. Often the case of how you manufacture and scale. Let's say you're looking at a business which requires, a specific type of blood, cord blood, for example. Does that create problems in scaling manufacturing in terms of being able to access that cord blood, for example? So addressing that, thinking about it as okay, look, I can get it now, but how am I going to get that longer term? Have I got any links into certain industries, into certain institutions that will help me to scale this when I'm not doing it on a micro level, but I need to make it on a macro level? Have you thought about regulatory approvals? You see this sometimes you don't. If you're doing a new drug, have you thought about the process of going for an NDA in the US? Have you thought about the process of getting things approved locally? Again, you don't have to have that experience. Some people will, some people won't. But again, having thought about it, as part of your business plan, because it affects your timelines. It affects in terms of how you want to develop the technology, what you can do with it, how you stuff on it. Allude to those facts. What are your key business risks? We've got, unfortunately, we all know macro social issues at the moment that are happening in the wider world. Does that actually impact part of what you want to do? If you're in a business that is heavily reliant on semiconductors, have you got a problem? Because at the moment, semiconductors are really hard to get because they've been used in weaponry and things like that. Does that create for you longer term problems? So, acknowledging what the risks might be, again, think about ways you can overcome them, really useful. Related to reg approvals, do you need specific licenses? If you're handling, human cells, you need certain approvals, things like that. Just thinking through that, where you're able to and do a bit of research into it, really useful. And then just on the supplier customer part again, think about who you need to help scale that business from that business longer term. Worth thinking about. And finally, what does this all mean? What does the investor want to see? So you've delivered this great talk, you've talked them through the technology, you've talked them through how you scale the team, you've gone through how they're going to, how you're going to spend the money, what they don't want to do at the end of it. Just think this is a brilliant, deck. Really love it. Right. I think I've got an idea of how I'm going to make some cash, but how am I? And what underpins that? It's a nice intersection onto Adrian to talk about IP strategy and business models. Sam, over to you. The camera might trap me, so I might just stay here. The benefits of technology. It is. So I'll just stand here like a shadow.
Okay. Hi everyone. As Dan said, I'm Adrian Twingy from the team in Wessing, and we spend our time working with startup companies, licensing their foundational IP out to their parent institution, developing their IP strategy, and then really helping them take it forward, both in terms of customer agreements, so how are they going to get their product or their service to market to generate some revenue, how are they going to do R&D collaborations, and then ultimately, in some cases, how are they going to partner with a bigger and better funded organisation as an exit. So where does IP strategy fit into what Dan and Ollie have been talking about? Before we get to that, I thought we'd just take a couple of slides just to bring everyone up to speed and make sure we're all on the same page in terms of what IP is. I'm sure you've been to seminars probably here and elsewhere in the university environment where people talk about that in detail, so we're not going to spend a lot of time on it. But fundamentally, IP rights, so these are legal rights that grant their owner protection over information and ideas expressed in a particular way. And they include patents, trade secrets, confidential information, know-how. Very often in a biotech context, that's what we're talking about. But increasingly, it can be algorithms in an AI-based business model. So that can be protected as a trade secret. We can be talking about software copyright, protecting the expression of code, so the software in which the algorithm is embodied. We can be talking about things like database rights, and then less likely, in this context, things like trademarks and designs. So those typically are more important in a B2C business model. Designs that can be important, particularly in relation to some consumer devices like drug delivery devices. So these rights, they help biotech companies to demonstrate ownership of essentially what is of value in the business. They're valuable assets and they're attractive to investors. So they will attract quite a lot of attention in these conversations that Dan's been talking about that you have with investors. They will want to understand what it is that you own, what it is you have a license to do, and how that tracks onto your business model. And the final point to note is one size doesn't fit all. These different IP rights are necessary for different business models. So the type of IP right that an AI-based drug discovery platform will be relying upon will be quite different, and their IP strategy will be quite different from, say, a small molecule pharma company. So patents are a particularly powerful type of IP rights, obviously, it goes without saying, and traditionally they were the underpinning IP rights of a lot of successful biotech companies. So we're just going to spend one slide doing a bit of a deeper dive on patents, again, just to make sure that people are familiar. So patent protection is an exclusive right to do certain things. So to use, possess, sell, transfer, commercially exploit an invention. So it's a negative right. Actually, in effect, it stops other people from doing those things. It doesn't actually give you a positive right to do. If there is third-party IP out there, that might interfere with your ability to exploit your own patents. But what your patent does is it prevents other people, your competitors, from doing what you're doing. The invention must be a product or a process. So let's just pause there. We've talked about protecting information, and in the biotech sector, a lot of what comes out of your R&D project in your parent institution will be expressed in terms of information. This is data, this is results, these are concepts. To get a patent, what you have to do, and what a skilled patent attorney can help you to do, is to work out how you can claim that information content, but it has to be done in the form of a product or a process. And in biotech patenting, that is one of the challenges, one of the reasons why you need a skilled biotech patent attorney. I'm not one of those, so we don't do filing and prosecution. You would need to speak to someone else for that. But I'm very happy to tout their skills, because it is quite a tricky thing to do. Next point to note is that it has to be new, it has to be innovative, so in other words, not obvious, and there are various other criteria. So these are called the criteria of patentability that your patent application has to satisfy to move from the application phase to a granted phase. Patents don't arise automatically, they are so-called registered rights, so you have to file an application, probably goes without saying, and then that application is then examined by a patent examiner in a patent office, and then he will decide whether or not to allow to proceed to grant. And really, the invention, the technical information has to be disclosed in the patent application. So this is part of the bargain. You get your monopoly, your exclusive right, your right to stop others from doing what you've come up with. But the bargain is, in return, you have to disclose what it is. The idea is that after your 20-year term, other people can come along and then you have taught them to do what you have been doing. And that means that technology can then advance. And I suppose a lot of you guys will spend time reading other patent applications in order to understand what it is other research groups have been doing. Another point to note, patents are national rights. So there is no such thing as a global patent. There are a few cross-border patents which cover certain regions of the world. But basically, one of the things you need to have is a geographical, so-called patent filing strategy, where you'll file initially in one country, typically here in the UK, and then at a later stage, you will then seek to expand your geographical scope of protection that you've got. As I've said, the basic term is up to 20 years. And again, your investors will want to understand, how much of that has gone by, if this has been a patent that was filed a long time ago, how much is left expired. And another key point to note in the biotech sector is that not all subject matter is patentable. So not all results coming out of R&D are patentable. And a few examples are here on the slide. Confusingly, exclusions from patentability on the grounds of subject matter, non-patentable subject matter vary from country to country, region to region. So, for example, in the US has decided that genomic DNA is not patentable because it has in its law what it calls a product of nature or a law of nature doctrine. Here in Europe, the Biotech Directive expressly permits patenting of isolated and purified genomic DNA. Methods of therapy or diagnosis, so those, to the extent they're practiced on the human or animal body, those are excluded in Europe. But that isn't a problem for in vitro diagnostics, for example, because those are practiced on the human body. In the US, methods of therapy are patentable, but there is a defense for clinicians. So clinicians don't need to worry that people will be examining what they're doing in their consulting rooms and trying to interfere in their ability to treat patients. And obviously here in Europe, more so actually than in the US, we have a problem with human embryonic stem cell derived inventions because those are excluded under the Biotech Directive in Europe on the basis of so-called public order, so public morality. The exact contours and parameters of what can be patented and what can't be patented is a bit of a minefield. It's a tricky issue. It's not an issue that that investors will expect you to be an expert in or to be across. That is something that, in effect, you will have to get some guidance on from your parent institution patent attorneys. So whether that's CI UK, whether that is your university, and their tech transfer office, they will be able to give you some guidance as to what aspects of this research output are patentable. And that will be, that is really a key piece of information that you will need to then take forward as you evolve your IP strategy. Final point on this slide is that while patents underpin, as I say, a lot of successful biotech companies, there are increasing numbers of software and database spin-outs where there is no underlying patent protection. And that's particularly true given the sort of increasing importance of computational biology, bioinformatics, and the AI-based drug discovery platforms that I mentioned earlier. So with that as a sort of recap, a refresher on IP, let's talk a little bit about IP strategy and its importance in the discussions with investors that Dan and Ollie have been talking about. So first point to note is, well, what is an IP strategy? And it is basically, it's a plan for the ownership, in-licensing, management of IP in a way that's consistent with and supports the achievement of your business plan. And we can tease out a few separate issues here. So there are in particular two aspects to this. First is how to ensure freedom to operate for your business, and in particular for the therapeutic assets you might be developing, the other products and services, and the business operations that you are intending to move forward. So freedom to operate basically means that as far as you know, there aren't any third-party patents out there that will lead on and impede what you're doing. And the second aspect is to do with ownership. Are you confident that your company will own or have a license for the parent institution of what it needs? The flip side of the coin is to do with barriers to entry. So to what extent does that in-licensed IP or your company-owned IP, how does that provide a barrier to entry, which will keep the competitors that Dan was talking about on an earlier slide, keep those competitors at bay and allow you therefore to maintain your margins in the market. So there's no price erosion. So those are the two key points that you have to think about. And as I've said on the slide, the high-level takeaway message is it's the link between the IP and the business plan that investors want to understand. So Dan was saying to me when we were talking about this earlier, he sees a lot of proposals, a lot of suggestions where people say, well, we've got a patent, and that's it. And there's no attempt is made to explain what the patent covers and how that is useful protection in delivering either of these two things, freedom to operate or a barrier to entry against competition. So as I said, biotech, for a spin-out foundational IP will come from your institution. You need to speak to them about what they think is achievable in terms of the IP. The biotech investors will be particularly interested in patent protection, so they will be expecting to see something about patents. And if there are no patents underpinning the model, then you have to be ready to explain how else you're going to achieve a barrier to entry for competitors. If there are patents, then they'll want to understand, I think, how far has the application progressed? Has it been filed? How far has it got in the process? Is there any guidance from the university or CRUK on the likely scope of protection that would result? And they'll also be interested in the scope of in-license rights you think you can achieve into your venture. So as I say, risk of repetition, speak to CRUK, speak to your parent institution to understand all those things when you're putting your deck together to speak to investors. Investors are very pragmatic, so they will understand that a business, particularly in the early stage, may not have a settled business model. And we'll come on and talk in a couple of examples. We've got some work examples that we can run through the types of business model that you might develop might be available to you coming out of a particular research project. They will know that all of those are a possibility, and you may not have settled on one particular one. But I think it's just giving some thought to the idea, being ready to explain to investors, well, we could run this business in one way, we could run it in another way, and they will be happy to be part of that discussion, I think, because as investors, they will have experience to share as to which business model is most likely to be successful in the market. The people who you attract onto your board will also have similar experience. So evolving and settling on a business model is a process. It doesn't have to be a sort of fait accompli, a fully developed plan that you put in your IP, in your investor presentation. And they'll also understand that the patent applications are at an early stage. And so they will understand that you can't be particularly categoric about the scope of protection that's likely to result from those. They'll also, Dan talked about pivoting, so they'll also understand that there is a likelihood the business will have to pivot. And that in turn is something you need to take into account in your IP strategy. There's no point focusing your IP strategy such that your patent and your claims only cover one business model if you then find out that has failed in the market and you need to pivot, and at that point it covers it there. So bearing in mind the likelihood, the risk of having to pivot when you decide how you're going to develop your IP portfolio is important. And they'll also understand that all of this costs money. Filing patents is expensive, and they'll understand that there's a budget challenge there. But I think, and Dan will be able to comment on this more, if you say, well, this is the reason why I need part of the money, part of the reason why I've costed the money to get to the next stage, the next inflection point is we need money for IP filing, then the investors will understand that. So I think they'll take some confidence from the fact that you've put together an IP budget, and that's part of the reason why you're going out to them to look for investment.
Absolutely the case. And also, just something to bear in mind is, if you've got a business that's got a patent application in it, we're aware that the claims in that are going to get limited, right? And so we're not expecting the viability of business doesn't necessarily depend on all the claims in a wide patent application getting granted. We'll do our own research into it and talk to you about, the likelihood of that and how it interplays with certain aspects of the business plan, as Adrian said. But we won't just judge it on the basis of patent application, assuming that the viability of business is just going to be contained to everything you're initially applying for. We would be expecting to go through that process to work with you on how those claims gets narrowed, and also on how you approach your wider global IP strategy as well.
Yeah. And then a final thought I think on this slide is that don't be too intimidated by the name of an IP strategy. As I say, it's really just showing that you've given some thought to matching the IP that's available to you with how you think you're going to generate revenue. Pharma companies, for example, have got IP strategy, product lifecycle management, as they call it, down to fine art, and they evolve incredibly elaborate IP strategies, particularly around small molecule pharma, where they claim all sorts of follow-on. It's not simply the original therapeutic molecule, the composition of matter, but then they will develop a whole portfolio of patents around manufacturing technologies, things like crystal forms, formulations, second medical uses, dosage regimes. They will build a whole patent portfolio around the product once it has been authorized and is on the market. That level of sophistication is way beyond what is expected here. No one is expecting to see that, so don't be too put off by that. So let's move on then and look at a couple of examples where we're going to take some types of research output and think about the business model that it could support and think about how IPR can be part of that story. So the first is we're just going to take as a generic platform drug discovery technology. This is a fairly common business model coming out of academia in particular, and drug discovery platforms that come in all shapes and sizes. I mean, local examples, for example, we've got Kymab, the Kymaps, which generates fully human antibodies. Before that, the previous generation of technology, we had phage display, so the phase 1, 2, and the pathogen patents, which went into Cambridge antibody technology, again, in order to generate fully human antibodies. Other examples, even earlier, Cohen-Boyer patent on recombinant DNA. You sometimes see manufacturing technologies which could be thought of as a platform, so things like hybridoma technology that came from Cohen and Milstein, or antibody manufacturing, so the cavity patents that cause problems for biologics manufacturing for many years. So all of those you could think of as platforms, but here we're really talking about drug discovery platforms. And you've got three business models, basically. You can keep the platform for internal use, so you use it to develop your own programs internally, and then you can develop therapeutic candidates, take them forward to a certain point, and then much in the model of traditional sort of small molecule development, you can then look to out-license it or partner it. You can license out the entire platform so that someone can then run the platform themselves internally. A key point to note there in terms of the IP model is if you're going to do that, then you need to make sure that your parent institution is giving you some license rights in your license, because then you're not running it internally, you're licensed to someone else. Or the third is sort of an enabling model, where you partner in collaborative R&D with a third party and you help them to develop their products. So they may come to you and say, look, we want to develop a drug candidate to a particular target, and we think that your platform is going to help us accelerate us being able to do that. Can we do a deal whereby you're deploying your technology internally, but not ultimately you're going to hand it over to them to develop? And an interesting point to note here is that in that project, the output is unlikely to be covered by your patents. Your patents are on the platform. They're not going to be on the composition of matter that results from the platform. And in fact, those patents, the composition of matter, will almost certainly be owned by your partner. They will probably insist on owning those. But you can still develop your model that basically says, we're going to outline, we're going to do this collaborative R&D, this enabling model, and we're going to meter our royalties on the basis of the success of the product. Even though your patent doesn't cover the product, you can still say the license, the amount I'm going to charge you for my internal use of my technology, I'm going to say the value of that should be metered by reference to the output product, how well that does in the market. So then you're charging milestones and royalties on the development of that clinical candidate in the same way you would be as if you had actually, in the first business model we talked about, take forward yourself, if you had developed that internally and then file the patents yourself in your own name. And then on this, so this is a separate example that we can just spend another minute looking at. So here, this is a research project which identifies and sequences a disease-linked human gene and expresses the protein product. This is probably a little bit out of date given the way that things move on, but let's take this as a sort of simplified example. That information, so the fact that the disease linkage of the gene sequence, and then the protein product, you can deploy in a whole host of ways. And just running through them, the model could be to sell the protein as a research reagent, much simpler in terms of regulatory pathway than trying to do anything diagnostic or therapeutic. You could make and sell antibodies directed against the protein, again, as a research reagent. You could make and sell antibody-based diagnostics. You could make and sell DNA-based diagnostics. Performing DNA-based rather than selling those, you could actually have a service-based business model where you say, a bit like, for example, of the American diagnostic companies like Myriad with its BRCA1 and BRCA2 tests. You could say, we're going to develop a model whereby people take samples, they send them to us, we process it, so we deliver the diagnostic service in-house, or a service-based business model. You could talk about making and selling the protein as a therapeutic product. You could talk about using the gene and the protein in-house for screening, so drug candidate screening. You could use the gene sequence in gene therapy, and you could use the gene to develop an antisense, a therapeutic based on an antisense approach. And there are almost certainly others as well. So when we're talking about, coming back to what Dan was saying, what is your model? If you say that we've come up at this really interesting piece of information, we've sequenced a gene, we've identified that it's disease relevant, and we've expressed its protein product, then what you need to then think about is, okay, that is information, that's not a business model. The business model is one of these, or a combination of these. And then in terms of ultimately deciding, well, how do my patents read on this? Then you would need to be considering, okay, so how much of this can be patented? And that goes back to our previous discussion about exclusive subject matter, how you might go about on a global basis prosecuting patents, for example, in the key markets like in the US and in Europe. And that's, at the end of the day, as I say, this is probably a slightly out of date model because in the post-Human Genome Project era, my understanding is that obviously the genome is now being published, encoded, and so most of its encoded proteins are well known and part of public knowledge. So the other issue you have with this is not simply excluded subject matter, but also is any of this novel? Coming back to one of the requirements for valid patent has to be new. So there are multiple issues you need to think about when working out what might be patentable and how that could underpin the business model. But as I say, the starting point is to just think about these issues in the way that investors will think about them, and then you can get some input from your parent institution and their TTO and CRUK to help you with that.
Perfect, Eric, thank you. That just sort of wrap up because we've got some great questions online, and if everyone's okay to stay a few minutes longer, just see if there's any questions, I'm really happy to field them. But just some kind of wrap up thoughts really to kind of contextualize, I guess, everything we've talked about. So first one is just be aware of the finance environment, what's out there, and approach life. It's fundamentally the key point. Work on your story, make sure that the elements of the story are wrapped up. It doesn't have to be a perfect story by any stretch, but having thought about constituent elements, really, really important. It will increase your chance of success because the honest answer is not everyone will read everything you put in your plan. So just address the key areas. And each type of finance comes with different processes, requirements, and expectations. For example, and I'm just going to show you our process, which looks complicated, but it gives you an idea as to the typical process that you'll have to go through with VCs and why actually sometimes you may not hear from them, or you might get a rejection because it's a volume listing. So as an example, and I won't go through this, but happy to share. But we get, if you look at this, we get input from our web forms, from personal introductions. We have to work out whether they meet our eligibility criteria. We then work out actually of those opportunities we've seen that we've looked at a high level, which ones we're going to take forward to actually look at in more detail. So it's a triaging step. That's just stage one, right? Because if we've got 700, we have to do that part relatively quick. It's no different for any other venture capital fund. So then you kind of go down, you do your screening aspect of it, you get to a point where you think, great, these people have thought about these various elements. I want to move this forward. I want to have some more detailed conversations. And then you come down to more detailed discussions. So you work out, you start having calls with the investment team. You know, they then work out, quizzed on your business plan, your thoughts about it. And then it becomes a whittling down assessment. We start to get external advice, whether that be on your patents, whether that be on the technology. You know, we might get advice on thoughts of market and competition if we think there might be an issue or there might not be an issue. And we start to get into, you know, if you've got an existing business, for example, we look at trading history, we look at, you know, the more practical side of things, as well as the IP side of things as well. At that point, you know, we'll go into, you know, even deeper diligence, and eventually where we come to is a point where we would say, okay, look, we're really, really excited about this. We really want to move forward with you. We want to put you forward to our investment advisory committee, which is our AC part, and then eventually to our kind of regulatory side of things, which is normally in-house step, but just making sure that for our regulatory perspective, we've got the consensus that we need. Now, and at that point, investment. We go through, we negotiate the terms of investment. It can just take time. And it can take, you know, you look at everything from kind of the quickest, you know, 6 to 8 weeks. If everyone's aligned, if everything's great, if everything's in order, you know, all the way up to, you know, it can take us between 6 to 12 months to spin out a company for an institution. If there's a lot of work to do in terms of spinning it out, if there are existing grants that's funding more work that we need to get consents from. So it can be a really complicated process. It's not a process that can often be sped up in some instances, but we will do our best to do that. But it is a complicated process. The bigger your organization, the more there is to diligence, the longer it can potentially take. So just to bear in mind, you know, you're doing this to get through this process quicker. Our process is not hugely different than most VCs' processes. It just is what it is. With a pure nature of investing in other people's money, we have to make sure we've done our diligence process. So, you know, just wrap up. You know, articulate your fundamentals. Pull together your strategy as part of your wider business plan, so you can have an investor understand the value of the proposition, and, you know, getting your company financed. Increase it. Message doesn't just increase your chances of doing well for you, but if you are a person who has, again, going back to you know, the cancer analogy, particularly with our friends at Cancer Research. A lot of times what matters to people who are developing therapeutics to treat people with diseases is actually it gets into the patient. So it's not just about raising money for you as founders, it's not just about enabling us as investors to get a return that we can repay to our investors, but also if you raise cash, you develop your product, that product goes in a human, it works. You've got a product for patients. And ultimately a lot of people, that is what drives them to bring a business in the first place. And so again, just important to kind of not lose sight of that. We are aware of that. We do align to it, you know, sort of as we're in this business, because, you know, we've had family history in certain areas, we've got certain, you know, rare other diseases ourselves. So we are intrinsically interested in what you do as founders, as people who develop in technologies. And it's important just to, you know, not lose sight of that as well. So I guess now we've got some 2 great questions online, which I'm happy to field. Any questions at all, you know, please do raise your hand. What I'll do, if it's all right with everyone here, because I know there is food waiting outside, and so I'm sure people that is rumbling, but I'll answer the 2 questions. I'll just read them out for everyone who's in the audience. Now go through those, and any more, very happy to answer. So the first question was, how would investors react to ideas that are in early development where no IP has been generated yet, and how should it present in the deck? So fundamentally, a proposition whereby it's an ideation company, it's an idea, it's a theory. That, you know, sometimes that theory can go a bit further to there being know-how but no patent. But I think this question is solely around ideation and how we approach it. So we at Start Codon will back ideas if we think there's a sufficient amount of evidence underpinning that it will work. So we will not just say no to a company that is a pure ideation company. They are riskier bets because there's no data. If you've got data, then as an investor, you can look at it and say, okay, look, there is data. This works in this model, it works in this model. But, you know, and it does make the decision easier because we've got to have faith it's going to scale, it's going to, you know, eventually treat their target audience. But there is data. So having a company that does not have data in this pure ideation is harder to finance. We have financed those businesses before. In terms of how it should be presented in the deck, you know, it's a thought process. It's a thought process that works. It's about talking about the thought process, where the ideas come from, explaining how that might translate, explaining in particular, what the initial experiments are, and how much money you need to actually prove whether there's legs in that idea. Because a lot of investors, won't necessarily want to put in a huge check until they've got at least some base data that it works. It's about working out what the MVP is, what the minimum amount of data generation is, and how much cash you've got. And then, in many ways, the exciting thing about companies that are ideation companies is that if they're a pure idea, particularly if they're doing something that's not been done, if it's successful, the chances of that growing rapidly and raising finance are quite exciting. So we don't dismiss them off the bat. But if you, in absence of data, you've really got to show how you spend the cash to generate that initial data set, and then how that can possibly scale, particularly in relation to things like unmet need, market competition, and so on. So it is a different proposition. It's not a proposition that we're written off straight away. Some investors do like data, they do like patterns. Some are likely is a bit more flexible if there is a well thought out plan, coming back to the point we're making here, that underpins it. Second question was if the product had several potential markets, like animal diagnostics, human diagnostics, environmental or product monitoring, how would you best pitch several markets without looking distracted or focused? Great question. So platform technology that can do lots of things. You think it can do lots of things. How do you, how should you pitch that fundamentally is how I've interpreted the question. Well, we invest almost exclusively in platform technologies where you can apply different models that Adrian's talked about in terms of how you commercialize. I think it depends on what data you've got. If you've got a technology that has generated IP primarily in animals, it doesn't mean it could be applicable to say humans. Using the example we've got there, it doesn't necessarily mean it is. But it's about looking at the data you've got and having a think about how you might apply that from a business, from a strategy point of view, from a business point of view, going through all the elements that we've talked about. Platform technologies are great. You don't, but people, going back to the focus point, people tend to want to do everything all at once. That is the strategy, because you find a lot of, it's a bit like the analogy of jack of all, master of none. So I think in terms of how it's pitched, I think it's about developing, looking at specific areas, particularly where you've got the most data, looking at opportunities in those areas. So animal markets and human markets are very different things in terms of opportunities, in terms of how much money you can get, how you can commercialize. So it's about thinking about all of those, focusing initially on a main focus area, and then appreciating that you can do other bits with the IPs. If you have a genuine platform technology that can be applied across different verticals, there is an opportunity to hire bits of that IP out to different entities that other investors should focus on, and you can get money longer term that way. But it's really about focusing on specific areas, typically where you've got the strongest chances of success, and you can write the most eloquent plan and thoughts and forecasts. But also appreciating then that there is other IP that can be developed, and talking about that. You may want to, in the future, allude to the fact that you want to do, say, certain validation activities several years down the line, which could then form separate businesses or whatever. But it's really, focusing on, in my view, on the areas that are most likely to get you the investment at the point in time, whilst appreciating the variability in the model, scale, and that offers opportunities wider than just the initial focus area. I think that is it. Any questions? Yes. I'll repeat the question just in case there wasn't here. I think you should be able to.
Thank you for such a clear presentation as well. My question was regarding that often in the healthcare industry, the main obstruction to progress is not necessarily the technology or the team, but the resilience of a healthcare client who wanting to even engage. By nature of being in this domain, do you ever, as a venture capitalist, offer any contacts or connections to facilitate progression in that way? Beyond just financial support.
Yeah, and when we talk about clients, are we talking about
clients like a hospital, for example?
Yeah, or even sometimes patients, I guess, in many ways, right? So often we will have contacts. It depends on how niche the technology is, right? So if you give, let's take rare disease as an example. Adoption can be quite hard. Adoption can only be in certain very specific centres who might cater to certain rare diseases, and you tend to find that those centres are built around areas where certain rare diseases are prevalent. Just as an example. we may not have connections into that hospital, but we will know people who are used to accessing certain markets, who can then, hopefully then make the introductions, get the engagements, in order to get into that hospital, to meet that physician or that clinician. From a B2B aspect, you find that, how do you get it if you've got a particular tool? So you're a tools business in healthcare, and you're wanting to get access to, a particular supplier. Often than not, investors will have connections either through suppliers or to that into themselves, and they can facilitate introductions. To the extent that we can't, it's really about trying to find people who can, because we don't know everyone, or it's about finding ways that you can increase the likelihood of a response from that target person. Because sometimes you do have to do blind approaches. It's just the nature of the beast. But yeah, most investors will have networks that they can tap into. The extent of that network depends on the investor and what their focus is. If you've got an investor that is traditionally tech focused but steps into healthcare, their healthcare network might not be as established as a pure healthcare investor. Similarly, if you've got a technology that is it's not fundamentally healthcare, but the initial application is healthcare, then actually you may find in terms of other areas that you should explore that certain other investors have a better focus area in those markets. But you would expect that person, the investors to help either establish how you're going to attack and get access to those areas, or to know people who can get access to them. My background was in rare disease therapeutics when I was in industry, and a lot of that was really about getting access to, which is hence the example. But getting access to certain disease centres, certain people, working out who to talk to get things like reimbursement sorted for drugs and things like that. So, we often, and we used, our investor network to help get access to those. We use external consultants who we were in contact with. So there are ways. It's just establishing how niche the ask is and then building it from there.
Thank you so much. Can I ask a quick question, Dan? That was super helpful, thank you. But so on one of your earlier slides, you talked about appropriate resources and how entrepreneurs will get their idea or discovery from inception through to like a revenue generating business. In my mind, kind of appropriate resources are, money is the obvious one, and then there's obviously some of the other stuff you touched on, like talent and facilities as well, and keeping a business risk register. Could you just talk a little bit about how you view that, and in particular, are there any kind of like operational aspects where you ever think that this path that this company is going to take is just too difficult, they just will never get the number of people needed for that, or is it all that actually any problem could be solved with the right amount of money, but then that just skews the financial profile?
Yeah, so I think that if I'm going to condense the question was really what do you mean by appropriate resources to achieve the aims, and what companies need to do in order to ensure that they can fulfill that, or can you just solve it all by throwing a lot of money at it? In many instances, you can try to solve it by throwing a lot of money at it. I think you've seen a lot of people try to do that with what are called SPAC, which is special purpose access companies particularly in the US. So the idea behind those is generate a lot of IP, and then you basically bring it to stealth, and then you list it, you raise a load of cash, and then the theory is you bring a load of money in and just smash the problem to pieces with a load of cash. You've seen a lot of those actually fail at the moment for the exact reason that some things you just can't fundamentally throw cash out to fix. But a lot of cash does help, doesn't it? Because it gives you the ability to pivot and to invest cash into different avenues. What I mean specifically by appropriate resources is it's about working out, from a fundraising perspective, what you might need to achieve your aims at that specific part. So if we look at, so for example, in the early days, if you've got a small amount of cash, what do you need to spend? And who do you need to spend it on in order to get where you need to get to? So that's number one. It's about understanding that, I think also a bit that we struggle with, for example, is, this is the third session we talk about, which is all about talent and team, which we're going to have on the 22nd of September. But it's about understanding what you should spend money on as well, and that's because some things are just worth spending cash on at external parties. So getting a good consultant who might be able to help in terms of people strategy implementation is really a good one. law firms who can help, who can make introductions, again, getting big sure you get the right support at the right time, and partner with the right people. So what I mean by appropriate resources is you don't have to have all the cash in the world, but it's about spending money wisely. It's about picking the people and the entities that you work with and spending that money wisely, and appreciating that actually, there's an old adage which is you pay peanuts, you get monkeys sometimes, and it's not always true. But the point is that it's not always about nickel and diming everything in the early days. It's about focused cash spending on particular items that are going to generate the most value for you as a company, and using the appropriate resources you've got at the time to best achieve your aims. But yeah, I mean, going back to it, cash does help. I mean, there's no doubt about that. But you often, it's about how you spend that cash. It goes down to the point of, you'll find with some companies, it's about use of funds as well. So if we go to use of funds, you look at how a business uses the investment it's got. From a founder's perspective, raising a load of cash is great because you've got a load of cash, but it also might mean that as a founder of a business, you own most of the business at the start, you don't give a huge amount of the business away because you've got a load of cash on the table. Whereas actually, do you need all that cash because you're going to be expected to spend it? Or do you need a certain amount of cash, which might result in less dilution for you, to get to the next inflection point, which allows you to raise even more cash for the next stage, but you can retain more of your company. So it's not all just about raising the cash, it's how you raise the cash, how you use that cash and the people, the resources to get to your inflection point, and then how you then scale it up to the next inflection point. Because the best entrepreneurs I ever met, the ones who've done the most, who have been the most successful for themselves and for investors and patients, are the ones who've worked out how best to use what they've got at the time to achieve their aims, to then set themselves up to raise the next set of cash and eventually exit. And you find with those people, if you look at just the sort of stats, they have more of the business at the point they exit. So it makes, from a personal perspective, it enriches them, mentally and materially. But also, it enables them to have, to retain some influence over the business, over the shape of that business. And so, yeah, does that answer the question? Yeah. Well, I think we're out online. So thank you for everyone for turning up. Through for those who are in person outside, if you're together, and thank you for everyone online. Any issues, then do reach out, and we will share the slides in due course. Thank you very much. Cheers.